So if people just want to say in the general chat box or the Q&A box, if they want to say bullish or bearish for dollar, that would be great. And then we can all share some views, then we can get going. But while you're thinking about that, okay, Naeem's got everyone started. You're saying you think it's got further to fall. Okay, that's interesting. While we wait for some views, let's just go through our disclosures very, very quickly, and then I'll read your views. So guys, please do. I know some of you are real regulars, so I'm expecting the pounds and the rusties of this webinar to definitely contribute. The presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concept strategies and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The presentation has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient. We don't guarantee or verify the accuracy of the information commentary provided. It will include references to actual past trading results for discussion purposes. Futures, optional futures, foreign exchange and other leveraged products involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act, and contracts for difference, otherwise known as CFDs, are not available to US residents. That's because of regulatory reasons, guys. Okay, someone else is, okay, Fires, you're looking at you're bullish, medium to long term. Okay, but maybe not right now, maybe not in the very, very short term. But medium to long term bullish. I think a lot of people are probably in your position actually, with some people maybe looking for some near term falls or near term continuation of the weakness, but in the medium term for it to start rallying again. Now let's put this aside. Let's just pull up a chart. This is a cable chart. It's a cable. The white line is cable, as you can see. Fresh 5-year high this morning. It's quite wide. Sorry guys, it's crossing the whole of my screen. This is a Bloomberg chart, by the way. And then the orange line here is the, as you can see, is the spread between the UK and US bond yields. Now, this 10-year spread, the reason why we use 10-year is because it tends to be the, kind of the benchmark, basically. If we continue to see, I think there are two things to point out here. Firstly, if you go back to kind of say late Jan, early Feb, we've seen cable really start to take off. That's when it fell back toward that 163 level. Since then, it has really started to take off. But at the same time, we've seen the yield spread really kind of trend lower. So we saw a divergence there between cable and its yield spread. As you can see, if you just cast your eyes back, the first 6 months for this chart, the yield spread in cable, okay, fine, they weren't perfect, but they tended to move in the same direction. So that's the first thing to note. The other thing to note, of course, is this. So this is the second axis here, measures the this yield spread. And if I just use my tracker there, as you can see, for most of the last kind of 6-7 weeks, we have been below zero. So that's meant that US Treasury yields have been higher than their UK counterparts. That only changed on Friday. Some of you may be a bit surprised at that, and that's largely because, someone's just said, Richard, yes, sorry, it is a bit normal to have background noise. I do hold these in from a live trading, so you get a bit of realism, let's put it that way. So hopefully that's not a problem for you. But as you can see, just going back now to what we're talking about, this is what we've seen here is that from Friday, we actually jumped above that zero mark. So that spread has moved into positive territory, and it hasn't done that since the 13th of March. As you can see, from the 13th of March right up until kind of where we are now, we've had a big increase. So we've gone from kind of 166 to nearly 170, even though obviously that spread has been negative. So that certainly hasn't got in the way. Having a negative spread certainly hasn't got in the way of sterling strength. But now that the spread is in positive territory, and if it can stay there, that's another factor that could potentially boost potentially boost cable, get us back above that 170 level. Now, where can we potentially go from here? Because obviously, you know, a lot of people are looking at you know, the longer term. Obviously, it's like, you know, I'll just pull up my other chart quickly. This is cable on a 60-minute chart. As you can see, this is the RSI. So the short-term RSI is, at 85, so well into overbought territory. Likewise, on the daily RSI, that's just touching 70, so it's actually above 70 now, it's 73. So again, in overbought territory. Is that going to really kind of push us lower? We kind of think not, because if you actually look here at this, just look at this chart, just kind of, analysing the patterns, analysing the daily price action. As you can see, we've had plenty of days, really right away from February, whereby we've had big pushes higher on the upside, yet the downside has just been quite small. And actually, in the last kind of week or so, we saw the range in cable really shrink to quite narrow, and then we obviously popped higher today. So, the fact that a very good payrolls report couldn't knock cable off course, I think is quite a positive outlook there. Obviously, there are a couple of things that are boosting cable. Number one, you've got the weakness in the dollar for sure. You've also got real strong economic data. In fact, the OECD, so the Organisation for Economic Cooperation and Development, have released their latest growth forecast today, and they're now forecasting the UK to have the fastest growing economy in the G7 for 2014. What a difference a few years, mate, a couple of years, mate, really. Our growth picture has just turned around so dramatically. It's expected to cool off the second half of the year, but certainly the data that we've seen so far really suggests that QT got off to a very, very good start. So just looking at it that's the fundamental side dealt with it. We've seen the yield side is also supportive. It feels like everything's coming into play. What about the technical side? Well, obviously momentum indicators, yes, they're starting to move into overbought territory, but they're still suggesting the bias is higher. Also, just looking at it from a very, very basic perspective, we've still got these series of higher highs and higher lows, and that is your typical uptrend pattern. There's no pattern yet telling us that this is that we're about to change trends, that we are getting stretched to the upside. Nothing as yet. Now, obviously, from a psychological perspective, 170 is important, right? Of course, it's going to be important. So that could just cause a little bit of just a little bit of maybe a pullback, but we can only pull back at the moment. Will be shallow. If I just bring up my other chart here, my cable Bloomberg chart, I'll just show you, because it tends to be slightly easier sometimes to look at longer term charts on. Let me change that to a line on Bloomberg sometimes rather than anything else. But as you can see, if we can get here, actually I might need to go back to the candle, hang on. If we can get here, then basically 170.43, that was the high from the 5th of August 2009, that comes into place. So if we kind of stay, where we are right now, that's a very positive development. If I go all the way back to, say, 2007, so basically, where could we go above 170.43? Because there's, we could get there fairly quickly. Certainly, the way that cable has been going. But what you want to know is, what does that mean? Well, in terms of the next level that you go to, the 2000, it's a massive level. Basically, 173.20. 50% retracement of that high from 2007, which was from the November 2007 down to that low that we saw on 23rd of January 2009 at 135.03. It seems like a long time ago that we were 135 in cable. I remember it well. I was in the States at that time, so it wasn't particularly fantastic if you were earning in pounds. Someone said, would you fade sterling? I think if you're fading sterling, it's got to be a very, very short-term trade. Let's just go quickly back. This is the chart that I just showed you is very long term. Look at it from, I think you need to be looking at an hourly chart at most. And I think if we were to see a pullback, obviously 169 is going to be quite significant. Maybe even this kind of 169.20 level. But I would say if you're going to fade sterling, fade it in very short term move. Now I agree with you that there certainly could be there's certainly potential for it to hit some resistance. I mean, as you can see here, we're flattening out a little bit because we're now hit that 86, 87 level in the hourly RSI. Well, I do think, if the stars are aligned, or the factors are all lined up to support cable, then I really think that any pullback would be quite shallow, just to really kind of, maybe, help people to get back in at a better rate. I think a lot of people are looking for 170 now in cable. You know, there's been a ferocity in that move, and the dollar just really isn't able to cope with too much strength right now. So I think potentially back to these this kind of 169 level, maybe this sticky level that we saw on the 1st of May. You know, if we were to get below there, then obviously the lows from Friday, post that payrolls report. But even post the payrolls report, we didn't get below the lows from the 30th of April. So, you know, again, it's just reinforcing that uptrend. So that's why I think any weakness would be short-lived. As I said, 169 could, you know, an even number that could attract some buying interest. But if we were to get below the low from Friday, which comes in at 168.21 thereabouts, and then I think that could just suggest a deeper pullback. So watch out for that level. Naeem is saying it's trending higher, so better to buy dips or trending lower. Well, you know, that can sometimes be the way. You know, I think, you know, there is a lot of market chatter that, you know, people are still quite interested in cable, you know, on a longer term basis. So some people are really looking for it to continue to rally, potentially all the way back to 2. Obviously, there are risks to that view, risks to, you know, the UK economy to start with, and if the Bank of England like it. But we've definitely seen there definitely looks. The patterns anyway, the technical picture, the fundamental picture, and the yield picture is now all in the pound's favour, and those three things can be very, very powerful when they work together. So that's my view, and as I said, I'd look, you know, potentially to pick up anything on any dips, maybe back to that 169 level. But as I said, if we were in the short term to pull back below 168.20, that would be that would be short term bearish, and suggest that pullback could be deeper than expected. Now, just to show you how weak the dollar has been, take a look at the dollar index. I know some of you will know that I watch that quite closely. Dollar index is quite a useful little thing, because it shows you the dollar against all its major trading partners. And I think it's a useful way to just get a grip on how the dollar is trading on a broad basis. As you can see here, it's trading very, very weakly. Let me just pull this up a little tiny bit and just zoom in. This very, very long candle, the long upper shadow here, came after the better than expected payrolls report. Remember, that was 288,000, the largest payrolls reading for many, many years. And yet didn't last, right? Whenever you get very long shadows like that, you've got to be very wary. As you can see, you know, you've basically got all shadows there. Very long shadows suggest that, you know, a lot of sellers came in once we hit that high at 70, just below, you know, 79, kind of 84, which is the 50-day moving average. That really capped the upside. And since then, we've just been falling so sharply. Now, we have had a very sharp sell-off over the last 24 hours. That's partly driven by fundamentals. We had best data out of the Eurozone, some real surprising data out of Spain and the periphery. And you know, the market is just willing to ignore the better data that we've seen out of the US. Now, just to recap your minds a tiny bit, if I spread this out a little bit, go back. Back at the beginning of April as well, we saw a better than expected payrolls reading from the US for March, and again that happened, and we got another rally. It looks like we're doing exactly the same again here. It goes against all types of fundamental logic, but I think it just, you know, that's sometimes where the fundamentals can, you know, they can have their limits, in the sense that, you know, the dollar, you know, it appears that, you know, right now that it's just suffering from, it's just unfashionable to be long the dollar, really. People aren't liking it. There's obviously, you know, there has been a huge improvement in fundamentals in the Eurozone. I mean, you know, we had a very strong drop, or a very large drop in unemployment. We also had better PMI data from Spain, from Italy, for example. So there's definitely pent-up demand there for euros, but doesn't even seem like the threat of QE from the ECB, even though we think it's a very low one, doesn't seem to be scaring the market whatsoever. So they are really pushing the dollar down. Now, whether or not this actually triggers some ECB action on Thursday, remember the ECB and the Bank of England both meet this week. That's going to be really interesting, I think, to watch. I'll just show you a quick euro dollar chart. And as you can see here, fantastic move higher. We had been as high as 139.5 today, but we've kind of backed away from there. 139.67 is still the high from the 13th of March. That's kind of the near-term level that we're looking at. But as you can see, that's, obviously then 140 is very much on the cards. We've said before that we think 140 is a bit of a line in the sand for the ECB. In the past, when we've hit 140, they've come out and basically said that try to talk down the currency, and it did have an impact there, an impact kind of around about this level when we got to that 139.67 level. Again, another long shadow. What was that triggered by? That was triggered by the ECB coming in trying to talk down the euro, which worked for a while. It got us back down to 136.5, but it didn't work in the long term. And right now, again, we're certainly trading in a range, but we're getting towards the high of that range. So I think we're going to stay range bound in euro. I don't really see us getting too much above 140. Obviously, that could change based on the central bank, but I think they're going to be very careful not to get us above 140 either. So I would watch out for that. That could really start weighing on the euro at that level. Neen, you're obviously mentioning about the ECB, that there's unlikely to do anything. Yes, I think that's obviously the consensus. The ECB, though, they can always surprise. They might still try to talk down the currency. I agree with you in the sense that I don't think that would necessarily have such an impact on the euro. But if they did want to have an impact on the euro and really send it significantly lower, they could do something which would really shock the market because no one expects them to. So they could do maybe a bit of a negative deposit rate, maybe cut interest rates, even though they couldn't really cut interest rates by very much. Some people are looking for a point or 10 basis point cut. I mean, that's not going to have an impact, but it may have just a knee-jerk reaction lower because the market would expect them not to do anything. I've never seen verbal intervention have a long-term effect. No, that's true. It hasn't. You could argue that, obviously with verbal intervention, depends how you see it. I would say that verbal interventions had a very real effect in the Eurozone because when Draghi said in 2012, we'll do whatever it takes, that was only verbal. He didn't spend a penny. And yet in the periphery, in the debt markets, it's had a massive impact, right? Because Spain's 10-year bond yield is now below 3%. That's had a very big impact. But I agree with you. I think you mean kind of more in terms of the impact on the currency. Now, if anyone else has any questions, then please add some. The other thing I want to show you is dollar Swissy, because there seems to be, there's potential room for further downside here as well. We had been moving higher, obviously, kind of the middle of April, but since then we've just really tumbled. There's a lot of kind of choppy activity. We're not really seeing any. We're not really seeing, any. Again, a bit like the euro. Really, it's trading in a range, even though it is trending lower. We're quite a bit away from an upside move now. Let me just bring this other chart up. Sorry, guys. I'll just pull up a Swissy chart. Here it is. As you can see, we're below the zero line now on the daily MACD. That is quite a bearish development. We crossed lower, and that does suggest that we could fall. So a breakthrough resistance where we're currently trading. We're currently trading around about 87.39, unless really we got back above these kind of highs here, around about kind of certainly around about kind of 88.60 in the very short term, and that would be a bit of a bullish development. From where we are now, though, support, we are currently relying on support, which is the key level. 87.44 is the low from the 11th of April. Let me just pull up this chart. We're currently trading 87.41, so we're just below there. So we've got below these April lows. The next level, obviously, would be the lows of the year so far, which come on the 13th of March, which came in at 86.99. So we're not far from the lows of the year so far. This is looking pretty weak. 86.99 is the March extreme. When we get below there, we could really start to look oversold. Be interesting to see what happens at that stage, whether or not we embark on another leg lower, or whether or not we actually bounce from there and trend higher. Obviously, the dollar selling does seem to be quite stretched to the downside. So we could be due a bit of a pullback actually. So that's certainly worth watching, but that's a level, that 86.99 level is really key. Obviously, if we get a break, or today, if we close below 87.40, and we're just around testing that level now, that means a fresh low for the month so far, would be, again, would be very bearish, especially if no one really picks it up, and we're looking like, there's not much upside there. As you can see, we've got kind of very little candle over wicks so far, so that is quite negative.
Excuse me.
Panel 5, does dollar weakness mean appetite for gold even though inflation is higher? That's a really interesting question, because obviously there's, you've hit the nail on the head there, in the sense that there's different factors that drive the gold price. So we saw gold rally yesterday, or rise yesterday. That was kind of a two-part move, maybe partly based on dollar weakness, but also a technical factor. We bounced above, or bounced off that 200-day moving average, which comes in at 12.99. So that is some key support. We bounced back above there. That's quite a bullish development, but right now we're trading in the tiniest range, so it's not having a massive impact. It's quite a frustrating pair to trade at the moment, because the range has been really small, kind of trading between 12.85 on the downside and 13.15 on the upside. As I said, in the last 24 hours, we've been trading between 13.15 on the upside at 12.99 on the downside. That's the 50-day and the 200-day moving averages, respectively. And you do have to balance these effects. So on the one hand, yes, a weak dollar can benefit commodities that are priced in US dollars, because obviously we need more of those US dollars to buy that commodity. But on the other hand, you've also got very low inflation pressures everywhere, really. So even though in the UK we had a better than expected service sector PMI, we've actually seen we actually saw the price component of that remain very low. In the Eurozone, the OECD, I mentioned that they gave out their growth forecast today. Well, they come out again and said, they came out today, they're joining kind of a big chorus of these international agencies who are calling for the ECB to do something with deflation. So we're reminded of low inflation pressures pretty much everywhere. We also know that even though the US is creating a lot of jobs, that wage growth was very weak on Friday. So all of those things are quite gold negative. So I think that could potentially be limiting the upside, because you don't need to necessarily buy gold right now as an inflation hedge. I think people are maybe being a bit naive on that side of things, but we just, in this era of QE, we just haven't seen this explosion in inflation. And if anything, as markets or as central banks come to end their QE programs like the Federal Reserve, we've actually seen kind of inflation fall off quite sharply. So I think, in terms of when could that change? Well, gold could be in demand going forward as a safe haven, because we think that, in the months leading up to October, when the Fed is if it continues with its current pace of tapering, it'll be the end of its asset purchases, or the end of the increase in asset purchases, I should say. We still hold on to a lot of assets, we think, but there could be a lot of talk about when they're going to start raising interest rates or take their next policy step, and that could be what triggers a bit of risk aversion, maybe interest in gold. And so what definitely worth watching out. Someone's asked me to look at Aussie, and I will, and then I'm going to look at a couple of emerging market currencies, because they've been very interesting. So the Aussie was in focus earlier, and that's because of the RBA meeting. They kept on hold. My colleague Chris Tedder on our website has written about it. So please do follow his updates. But as you can see, we've bounced off these lows. So this big long down candle here, or very long down, the wick to the downside, managed to find support ahead of around about 92, which was ahead of the 91.95 50-day moving average. However, we've certainly bounced from there. So we've bounced up 100 pips, and that's partly because of the dollar weakness, but also the RBA meeting remaining on hold. So for me, the Aussie is probably not the most interesting pair at the moment. But as you can see, we have been, we are pushing higher. A break above this kind of 93.10 level could open the way all the way to those 93.85, and then of course, the high still remains that kind of 94.75 level that we reached on the 10th of April, and that's the kind of the key level to watch out for. Someone's looking at the Kiwi as well. Again, all of these dollar crosses have been kind of beneficiaries of this dollar weakness. We've actually seen the Kiwi do really well. It is now so close, just 20 pips away from the high reach from 10th of April at 87.46. This could get some people quite nervous, because we just had a real there was a real issue about getting above that level, so getting towards 88. Last time this move higher on the 10th of April, that coincided with the RBNZ hiking interest rates, and not even that could get us to 88. So there could certainly be stickiness here, but if we can get above 87.5, get a daily close above there, that would be such a bullish development for the New Zealand dollar. That's a level that we'd be watching very, very closely. Okay, guys. I'm going to just. I want to just quickly let's look at the Turkish lira, just as something to watch from an emerging markets perspective, because I think it's quite interesting what's going on. So as I said, or as I whispered on about today, the dollar is incredibly weak. Even though we know that there are a lot of problems in the world, a lot of problems still in emerging markets. Even as early as last week, there were rumours of protests going on in Turkey. We've still seen the lira outperform the US dollar. So this is US dollar versus Turkish lira. As you see, we're testing a massive level, the 200-day moving average, which comes in at 208.98. If we get below there, a daily close below that 208.98, currently trading 209.43. That would be a very, very bearish development. Apologies there, guys. Just bring up my economic calendar. We're basically moving here on the back of overall momentum from that dollar weakness, I think. That depression in volatility, if I just show you the VIX index as well, when falls very, very sharply, you tend to see volatility 13, back at 13, and it's so low at the moment. It's just not been we just do a normal line chart. I think that's an easier way to see this. As you can see here, so low, volatility is just so low, and that's reflected in a lot of those crosses. I did mention, or I may have mentioned, that euro-dollar volatility and euro-dollar fell to 2007 low earlier. Obviously, but the VIX is a measure of Wall Street volatility. But what all that means when volatility is very low, it means that it can mean anyway that things like the Turkish lira, like emerging market currencies, they can rally, and that's kind of your perfect conditions for things like carry trade, things like your emerging market currencies moving higher. Hence why we've seen the Kiwi do so well, because that's the ultimate carry at the moment. And interestingly enough, we've seen the Kiwi do incredibly well, obviously against the dollar, and it could start to do quite well against the yen as well. As you can see here, it's actually not had such huge gains as it has versus the dollar in the very short term, but we could get back close to 90. 89.93 was the high on the 1st of April. Carry trade, your typical carry trade is going to be going long the Kiwi, going short the yen. And in this low volatility environment, that is very, it's quite positive on Kiwi yen. So that's certainly something to watch out for. I've gone over my time, guys, so we are spot on. But thank you, everybody, for joining. It was really great to hear your thoughts about lots of different things. You were good participants as ever. Please do join me next week for more. And thank you again, everybody. Thank you very much.